Hi, I'm Charlie Jamieson, Chief Investment Officer of Jamieson Coope Bonds, and this is a review of markets for March 24. Bond markets had a good month of performance in March of 24, but we're still in this wait-and-see period, waiting towards the middle of the year where we're expecting central banks will start cutting interest rates. There's a lot of conjecture about which central bank will be the first to get to rate cuts. Clearly, from the commentary, the Federal Reserve would like to be able to cut rates this year. But because of US exceptionalism, incredibly strong data that we're receiving in the US economy, they may not be able to get to that place, leaving the leadership to the ECB, the Bank of Canada, or the Reserve Bank of New Zealand. The US exceptionalism is really quite extraordinary at the moment. We've written and spoken a lot about the incredible and dynamic nature of the US economy, its long-dated and fixed-rate mortgage market, meaning that it's very difficult to slow down US consumers when they still have gainful employment, as they do. Conversely, if you take an economy like Australia with a very high transmission mechanism, once interest rate rises go into the economy, they affect mortgage rates for most mortgage holders very, very quickly, and they have that loss of discretionary spending power. And we're seeing that consistently with the incoming data in Australia, where consumer activity just continues to wane, and we must expect that that continues. We're getting a bit of a precursor look at economies like New Zealand that raised interest rates before the RBA and will very likely cut before the RBA, have been in recession now, technical recession, for quite some time. 5 of their last 8 quarterly GDP numbers have been negative, 3 of the last 4. And they're subject to all of the same forces that we are subject to here in Australia. So sadly, we have to expect that the economy continues to cool, and that will bring the RBA into the rate-cutting party by the third quarter, certainly the second half of this year. The US, however, being the world's major capital market, certainly garners most of our market attention. It gets a lot of media attention, and the employment picture there continues to be very solid. Inflation was higher to start the year, and that looks like it's a little bit embedded, certainly on the services side of the inflation picture. It's just a bit stronger than the Federal Reserve would like to see, and that is making it difficult for them to get to that rate-cutting party. And certainly, their commentaries, and if we take the leadership of Chair Powell, is certainly to the point that they do want to lower the cash rate in order to meet those realised victories in inflation. But this just bubbling of inflation, not really going back down towards the 2% mandate, we're just hovering above that 3% level, is causing some frustration, no doubt. And with things like commodity markets and energy markets now starting to accelerate higher, it's just making that disinflationary process a little bumpier than had been expected. And the market is just continually pricing out expected rate cuts from the US economy. And we think that's relatively rational and can continue for the US, no doubt. But it is a very different picture when we look across the rest of the Western spheres in the ECB, the Bank of England, the Bank of Canada, New Zealand, as we said. All of those economies are slowing, growth is waning, and the inflation pictures have improved considerably. So we do expect that the leadership from rate cuts for 2024 will come from those central banks. As we've written, we're not expecting large rate cuts, a non-stimulatory cutting cycle to match those realised victories in the inflation process. That's good news for most asset markets. Certainly a lot of asset markets are following that leadership of US markets for now, in the expectation that we will have some rate cuts this year. The irony, of course, is that if we don't get those rate cuts, it actually sets up 2025 to be a much more dangerous year, and it probably increases the probability of a harder landing scenario. The reason for that is by cutting rates this year, the idea is to smooth the economic cycle, to not run into a brick wall like we did in the financial crisis, where rates were left too high for too long, the delinquency started to really kick in, and once that occurs, it's very difficult to reverse. For a small business that's struggling, they're not going to hire extra staff because the central bank cuts rates 1 time or 2 times. They really need to see the economy get properly pump primed in order to generate that demand. And so the idea is to get out ahead of this so that you don't let those businesses get into trouble in the first place, where they start to have to cut back on employment and the like, and we're running dangerously close to that moment in many economies ex the US. So our expectations is still firmly that we will see rate cuts over the course of the back part of 2024. Thank you very much.